Have you heard about the Federal Reserve interest rate? Do you want to know its role and why it exists? If you're interested in finance and accounting, you probably know what this is about. But if you're just someone who would like to dig deeper or want to have a better understanding of what the Federal Reserve interest rate is, watch this video to know more. What is the Federal Reserve interest rate and its purpose? Although you may have heard about it in the news, you may need to fully understand it. The interest rate that banks charge one another is known as the federal funds rate or federal interest rate. Customers' interest rates, such as those in a personal loan or mortgage, are not directly correlated with the federal funds rate. However, it may significantly impact those interest rates and, over time, alter how individuals and businesses use credit lines. It is frequently provided as a range. For instance, the current federal funds rate ranges from 3.75 to 4.25%. Say Hera Bank lends you money at a rate of 4% greater than the rate it receives. When other banks charge 2% interest on loans in March, Hera will charge you 6% interest. However, suppose you wait until April when the federal funds rate has increased and other banks have begun charging Hera 5%. In that case, you will have to pay 9% interest. But it impacts the economy as a whole, not simply interest rates. Raising it is sometimes a good thing because of this. Understanding why it exists will help with understanding how it functions. How is the federal funds rate calculated or set? That is the job of the Federal Open Market Committee, or FOMC. The FOMC convenes at least 8 times a year, though additional meetings may be canceled if necessary. The committee uses key economic indicators that may indicate inflation, growing unemployment, a recession, or other issues that could hinder economic growth from determining the Fed's interest rate policy. Interest rates fluctuate between high and low periods. The Federal Reserve's responsibility is to maintain a healthy and secure economy. This entails maintaining high employment rates, stable prices, and moderate interest rates. The Federal Reserve's principal responsibility is to maintain price stability. Inflation is modest and steady when prices are constant over the long term. How does it affect you now that you're better informed in the federal interest rate and how it impacts the economy? Here are the 5 things you should know about how the Federal Reserve interest rate affects your finances. Number 1. Your spending patterns, mainly when using credit, can change. Getting people to behave differently is the key to changing the federal funds rate. That's you because you purchase things. You'll spend more money if the Fed lowers interest rates. Since credit is more affordable now, you'll use your credit card more frequently and consider it a convenience. You might even be eligible for loans. Everyone has a more positive attitude toward money during these times, so even if you don't utilize credit, you might buy more. However, if it increases, that level of spending begins to hurt. Your credit card changes from being a tool to maybe becoming an albatross when interest rates rise. As a result, you cut back on your spending until you have cash. You might be more inclined to save it than to spend it even if you obtain it. People desire to conserve money because they are increasingly concerned about the economy. You will likely to obtain a loan if you absolutely must. Spend what you can only afford. Number 2. Your bank loans or credit card interest rates may change soon. Fixed-rate loans should remain unchanged. However, if you have credit cards or loans with variable interest rates, their rates need to fluctuate in line with the federal funds rate. A decrease in the Fed rate may result in reduced monthly payments and lower interest charges overall for loans. When you pay less for borrowing money, you have more money to spend, save, or put toward any other financial objective. The process could take a month or 2. You could have time to consider other possibilities if they are rising. If it's a credit card, try to find one with a balanced transfer option and an introductory period with no interest. Refinancing is something you should consider if it's a loan. You'll be more cautious when selecting bank loans and credit cards if you keep these in mind. Number 3. Your housing status might be affected. If interest rates decline, you might decide that now is the ideal time to seize a mortgage at a cheaper rate than you might have previously obtained. You might even choose to use the equity you've accumulated or refinance your current mortgage to achieve a cheaper interest rate. However, getting a mortgage will cost more if interest rates increase. That makes purchasing less desirable, and you would be one of the many people to wait until rates decreased before doing so. Buying may become even less enticing if home expenses are also high, as they have occasionally been over the past few years. For instance, home prices reached previously unheard of heights during the pandemic, when our new normal transformed how and where Americans desire to live. Number 4. Bond interest rates fluctuate. While stock prices decline, bond rates rise along with interest rates. This facilitates the sale of new bonds with more excellent interest rates. On the other hand, If the Fed reduces interest rates, older bonds with higher interest rates might gain greater popularity than newer bonds with lower interest rates. It gives them a second chance in the secondary market. Additionally, businesses that have the option may use bonds with lower interest rates to pay off bonds with higher interest rates before issuing new quicker bonds with lower interest rates. Therefore, your investment portfolio's bonds should be able to maintain balance no matter what occurs on the stock market. Consequently, you shouldn't automatically feel afraid or joyful when interest rates fluctuate. However, how it affects you will vary depending on how many stocks and bonds you have, as well as how much of each you have in your portfolio. Even while bonds are typically among the safest investments you can make, some risk is still involved. Every moneymaker must eventually confront the boogeyman of finance. Yet, occasionally, the economy may not behave as anticipated. Number 5. Your savings may earn a better rate. The federal funds rate also influences the fluctuation of savings rates. This holds true for standard high-yield savings accounts, money market accounts, and certificates of deposit. However, it can take them a quick second to decide how much the rate should increase or decrease. This is particularly true with the traditional bank, which typically takes longer to make these adjustments than an online bank. Expect rates to increase, but not by as much as the Fed funds rate. Even if they do, they might be able to, but they might not. Furthermore, you will receive a different amount of interest on your savings than on a credit card. Even so, it's still preferable to receive nothing. If your circumstances change, you can still receive a better rate than you do now, even if rates decline. Therefore, just though rates decrease doesn't indicate you should unwind. It may be time to choose a different bank. Unfortunately, no matter what the Fed does, the advice on high-interest savings accounts remains the same. Be on the lookout for the best return you can obtain for a minor investment. Plus points if they include additional services you value, such as automatically conserving money for you. Knowing more about the Federal Reserve interest rate may help you manage your finances efficiently, with greater self-discipline. Suppose you know how to differentiate needs from wants and you're a responsible spender as well. You can have your desired personal investments. It gives you a different satisfaction knowing that your hard work has paid off just by looking at your investments. So, this is how the Federal Reserve interest rate works across the country and how it can affect you. Thank you for watching this video. What do you think about this topic? Do you agree with me too? Share your thoughts in the comment section below. Don't forget to like, share, and subscribe. I'll see you in the next video.